This is Satya Pradhuman of Cirrus Research. I want to bring you to our latest issue of the Market Conversations. This morning, we're very pleased to have a conversation with Ken Chiang. Ken Chiang and I have known each other. I was looking at the calendar a little bit, and I think we've actually known each other for about 20 years professionally. Just because I know Cirrus has been around for 15 years. I know when I was in my prior role, I covered him for at least 5-7 years as well. And so what, the Market Conversations series is about is really research people trying to learn. And this is a wonderful forum because we get to bring on some really smart people. We get a chance to sort of probe a little bit, and it's a little bit unfiltered and unrehearsed. What's cool, the bio that he's got up here is, I'm sure any active manager would love to present. Four-time Barron's 100 fund manager, Morningstar 5-star overall rating, S&P AA manager rating under his Milim days, or Merrill Lynch Global, which became BlackRock. The list goes on, and I believe that Ken, because of his diversity of his background. So I'll give you a little bit of that just because I've lived with it. U.S. fund manager based in Princeton during some of the earlier years, working on small cap global. So ran that product for a while. I got to know him a bit. And even in those early days, because I was just getting started in this area of research as well, what I picked up on was his depth. Classic fundamental manager, cares about companies, almost everything a strategist is not. And maybe that's why I think I really respect listening to what he's got to say. But then he moved on to the hedge fund world, worked at Chilton for a bunch of years, then went over to Hong Kong to open really the office there, working there. Then goes down the entrepreneurial path, which he and I both we have interesting conversations of as well. So he's opened Redwood Peak, and he's been running a hedge fund now for several years. And in that instance, it is global. Whether it's a small cap or an all cap, I think Ken has certainly been opening up how he focuses on markets. But make no mistake about it, performance is the game. I think if you look at some of his track record, I'm not going to go through it, but I just think that there's a difference between talking markets and running a portfolio. And every day here at Cirrus, we publish a lot. We think about markets. At the end of the day, though, it is about delivering performance. We do deliver some active baskets to clients for them to work on. And let me tell you, we track those. It is humbling going from research to running money. So at this point, what I want to do is really bring Ken on. And I'd love, at this point, we're going to get a chance to really get a sense of what Ken is thinking in this really, really important moment. So at that point, let me bring Ken on.
Hi, Satya. How are you?
Hey, good morning, Ken. Thanks for coming on board.
Absolutely. Yep. Great to see you this morning, and thanks for the great introduction and the slides. Looks like I've picked up some gray hair since I put your slides up because of the entrepreneurial route in these markets.
Yeah, there's a great joke about LinkedIn pictures. If your LinkedIn profile photo is not 10 years old, you're probably out of the mainstream. But yeah, no, I mean, time flies when we're doing this stuff. You're always challenged. Super important time to be talking about global markets. And, here at Cirrus, we had our early stages were super domestic centric, small cap. In the last 15 years, 20 years, we've begun to open up the focus on smaller companies across markets. As a researcher, I just find inefficient markets are special. I really I don't find it interesting looking at firms that have 40 analysts covering them. I'm not sure there are that many anymore, but yeah, at the end of the day, I think it's very timely. I'll take a step back though. In our recent sort of outlook reports, you won't believe this, but we managed to put the words pandemic, war, inflation in one title, and we weren't being apoplectic. It's really a fairly dramatic time. We've been using this phrase headline risks a lot, and I don't think it begins to capture the sort of moment that all active managers are struggling with. And so what I thought we would do is to give sort of our listeners a little bit of a sense of where we're going. I think we're going to talk a bit about, global equities, good, bad, ugly, et cetera. We're going to focus in on the inflation fallout and rate risk. We're going to then drill down into regional components, focusing on China, because I think, Ken's direction, specialty, I think you're going to bring plenty to the table there. The EM, DM debates, and really this focus on quality. We've been as a research team since about middle of last year, dug in on focusing on the profit cycle because it's going to peak. Therefore, margins are going to start to matter. Not in a million years did we think 9 months later war was going to break out in the Ukraine. So yeah, Ken, I'd love to maybe at a very top level get your sense of how you're seeing this environment with equities.
Sure. Thanks, Satya. I think you're right. We are in unprecedented times. We've actually go back, I think, over 25 years. We started in a world, I think, at least my career in 1991, where the world was globalizing, and there were merits to investing in diversified portfolio globally, global small caps, emerging markets. And that's what was largely precipitated by the end of the Cold War and the fall of the Berlin Wall. So companies and countries individuals could travel freely, could trade freely, could communicate freely, all of which, economics 101 created a incredible opportunity for growth worldwide. Whether you were an emerging market company in India with 100 million market cap like Reliance Industries, growing and dominating petroleum as well as telephony, and going to a multi-billion dollar company, and or whether you were a Russian company that was involved with aluminum production and now one of the biggest exporters of aluminum in the world, or whether you were an American company that was selling soap or detergent, now going into the global markets and doing the same and expanding the marketplace. In one fell swoop over the last couple of months, with the special operation, invasion, whatever you want to call it, into Ukraine, we are back to the Cold War. And so that has huge implications, I think, for the equity markets. It has huge implications for the reorientation of trade, huge implications for inflation. We, just as we thought we were coming out of a pandemic and we could return to normalcy, I think we are in a complete reversal globally, from a globalized world now to a deglobalizing world. And the net of it is that we are going to see an inflation tax, because the goods value chain has to be, and supply chains have to be rejiggered for moral reasons, which are very strong. Whether that's the headlines that we see right now, which is moving gasoline as well as gas imports away from aggressive countries like Russia to other modes of transport, and paying 3 to 5 times more for LNG from the United States or from Qatar into Europe, which then ripples throughout the world. I mean, I spent some time in Hong Kong, as Satya knows, and I just saw the electric charges. It was a warning that the bill is going to go up 50%, and that's because of European gas. Hong Kong relies a lot on LNG, and LNG prices worldwide have skyrocketed. So there's a ripple effect that's coming through. And then China, on the other side, is in a COVID zero mode, as probably a lot of you have read in the news. Does that have a huge implication? Absolutely. The supply chain in China is completely busted right now, so you can't move goods from Guangzhou to Jiangxi, or from Tianjin to Shanghai. So yes, Tesla's factory is up and running, but are they going to be able to get that ball bearing, from another province when the supply chain's closed? So again, ramifications for, are we going to be able to find goods at Amazon in 3 months to 6 months? Are we going to be able to find parts for delivery, for construction materials, for a doorknob delivered to your house?
Ken, you touched on a point there about, if we're going to more regionalized framing, and you begin to move down those supply chain channels and replicate those channels, duplicate those channels. Bottom line, that's called inefficiencies, right? And so this important debate about inflation that really started out of the pandemic moment, we could have debated that one squarely to say that is an event moment. The world shut down within days. It's going to take a while to start back up. We get that. That may not be secular. But this, in a single moment, we knew the fears that were formed during the pandemic about supplies and PPEs and so on. Those things were resonating, but then the war occurred. And all of a sudden, it's really front and center. And so the bottom line is, I was sort of in this camp to think that the initial hit on pricing was expected. We shouldn't have been shocked. I was really surprised economists were taking that into a secular call. But this moment has just moved the ball into sort of secular pricing inefficiencies. So bottom line, I do think, I hate using the word regime, but I do think we were spoiled in the last 20, 30, 40 years with incredible benefits of an open world, open market plan. And very quietly, we're now starting to sort of unwind these pins. And so, I think your point about the supply chain and the shutdowns that are off of this incredible curveball called the pandemic. I think over, in speaking with growth managers, they used the inflation print a week or two ago to become fairly optimistic, saying, hey, the rate of change on that should now begin to roll down. And I'm thinking that, wait a second, 6 months from now, we have another, supply shock coming.
No, I think that's right. And I think that supply shock is going to be a lot larger. I think the economy today of the United States is going to resemble a little bit more the 1970s, where essentially, what started out as a experiment, I think, to get us out of a deflationary spiral, which, if you remember, has been going on for 20 years. It was good at the beginning when we got a lot of cheap goods and commodities from overseas, and we could grow without inflation. It was magical. So it's been almost a generation of non-inflationary growth because the world has been open, whether it was China just constantly adding more production and the billions of people, 1.5 billion people, and other emerging markets with another billion people, to this what I would say a closed ecosystem between the G7 countries including Europe, a couple of peripheral countries out in Asia, Japan, Australia, New Zealand, Canada, and the US trading with each other. Suddenly, the marketplace and the supply chain increased by tenfold to what is now close to 10 billion people. The sticky part is that I think the world of the 1970s and the paradigm was that if everyone traded with each other and if we put the nuclear umbrellas aside, then the world will all become a happy place, and there'd be discipline from the markets against actors who were who are not complying, and the capital markets would take care of all. Well, we found out, fast forward, about 4 decades later, that we have authoritarian leadership in not one but several countries, some of whom are challenging the existing world order, if you will, with the US and Europe on top. And so we are in global competition on a national level, which is now eked into the commercial supply chains and the way we do business. So I would
Yeah.
fully expect that some of our end markets may start closing off as some countries decide to keep the markets for themselves, and that's the U.S. included, and or China included, or
Yeah.
Russia included, for that matter.
Yeah.
And countries who are reluctant but may have to start picking sides, and so
Yeah.
we'll have shrinkage in our end markets for a lot of companies. And on the supply side, as you said, we're going to have to rebuild supply chains and or find alternate sources. People we talk to on the ground in the manufacturing world would say it's very difficult. A Vietnam with 100 million people cannot replace a $1.4 billion population in China. They have 20 vendors who are eager to do business in China at any moment, and they not even a small deposit is even required for a test run of 50,000 or 100,000 items. But in Southeast Asia, you got to put cash on hand. Vietnam is full, it's closed, in that there's no more room for more factories right now. And so now they're choosing, gee, I don't want to make polluting textiles with dye going through our rivers. I want to make Samsung phones. And so they're going up the value chain as well. So that leaves us with India and Cambodia, Africa, as nations to work with. So it's very complex,
Yeah.
and
Yeah. Yeah.
it's I think the effect on the equity markets in general are going to look a lot more like the 1970s, where we get these inflationary bouts, and inflation stays because we've obviously closed off labor during the Trump administration in terms of immigration as a policy, as well as enforcement policy of labor from south of the Rio Grande, as well as tariffs on foreign products, which may actually find some leeway. But I think it really depends on a larger factor of moral relations between, let's call it that, China and the U.S. vis-a-vis Russia, and
Yeah.
being what was deemed credible actors. And it goes
Yeah.
both ways too. So.
You know, let's take this, let's run with this then. Let's bring it back now to Powell and the Fed. So, we're all trying to read between the lines here of those very few words of, what are they going to do? How aggressive are they going to be? And I do think in the last few comments, it's clear that they've picked up on the challenges that you've really well described really well. So the question is there an offset given the challenges with higher oil prices? I mean, how many rate hikes are there that have occurred because of the jump in crude, right? And so, the belief right now, if you look at some of the traders' forecasts, I think the Fed's going to tighten quite a bit. My sense, though, in the real world is that when you step back, you realize they're going to do a balancing act as well. It's interdependent. But what are you thinking about the rate risk at the moment? Because our bottom line has been, if there's rate risk, valuations matter, right? It just seems like there's no way that you're going to get multiple expansion in a world where interest rate risks or liquidity is getting tightened. So, but yeah, what's your thinking now about, we've certainly increased the focus on valuation as a discipline. In this kind of environment, we think we still have this overhang of innovation shares that are breaking. I think one of the best things that have occurred in the last 18 months has been we've had a full-blown correction of some of the most speculative pockets. Ironically, the smaller names within the innovation baskets have really come down. It's caused the Russell to really gap down against large caps. I also think, though, it's also sort of released the valve on how sort of corrosive this market pullback would have been. That we've had 18 months of a correction if you just look at the ARK fund and how it's trading. And to some ways, that's been a blessing.
Yeah, no doubt. I think what's happened is, we've had a series over almost a decade plus the pandemic period since the 2008 global financial crisis, where the Fed's been on survival mode, if you will, just putting a lot of extra fuel in the way of monetary stimulus and extraordinarily low interest rates for a long time. And so with a decade and a half of everything from QE1 to QE2 to Operation Twist to fiscal and more monetary stimulus that was even greater after the global financial crisis, well, all asset prices have gone up. So whether you take a look at treasuries, whether you took a look at bond assets that are in the rates risk environment, whether you take a look at emerging market debt, equities, real estate, Bitcoin. And so finally we got what I think policymakers were looking for, which is some inflation. I think they've overdone it. The Fed's behind the curve. And I can't square off, frankly speaking, why, if they're going to turn off the tap on monetary stimulus and reverse, why rates won't go to some premium over inflation. So I think financial theory 101 is that there should be some kind of rate premium over inflation. Now, expected inflation long term is much lower at like a 4.5% number versus where we're trending at 8.25.
Right.
So I think they're expecting some slowdown. But even if you were to price inflation 4.5, shouldn't we have a long bond rate of 5? And
Oh
let's see
my.
what happens to asset prices at
Yeah.
5. Your mortgage is at 7. Your real estate, your discount rate suddenly for equity risk premium goes up by another 3 percentage points, and suddenly those dividend yields that you think you're getting at 2.5 that look good don't look so great anymore on your stocks. And of course, the growth stocks, which were hyper pumped, whether they were the SPACs or whether they were the ARC type of new era companies, will come home to roost as your discounted cash flow number hits the growth names a lot harder with the far out update cash flow number.
Yeah.
So
Yeah.
from a
Yeah.
financial theory point of view, so I think the equity markets are very vulnerable. But like
Yeah.
you said, I think the steam being taken out of some of the more speculative areas, there are pockets of stock picking opportunities where there's some reasonable value. The emerging markets and China are dirt cheap right now. They've been thrown out, but we've got a rising rate environment, and what happens to small caps and more speculative asset classes like emerging markets and high yield in that scenario. So we might get a full-blown recession at some point, or what we
Yeah.
would call stagflation, which is a term from the 70s.
Yeah, it's funny you put a 5 handle on the number, right? I think if you go back 2 years ago, right, we were probably an outlier arguing that or a year and a half ago, the moment the vaccine came about and there was the beginnings of a reopening, and you've got this sort of shock to the system about reopening and supply chain. It just didn't seem to me that the 10 years should be below 1%. And so we had like a 2.5 in mind as we were plotting the outlook, and we've blown right through that. And there's enough smart folks now in the 4 or 5 plus handle on the 10-year, and that's radically different from what we've grown up in the past few decades.
Oh yeah, I mean, I
Yeah,
think it could be, if the Fed doesn't start acting. I mean, clearly there's pressure because there's a whole portion of the U.S. population that lives paycheck to paycheck, and they're feeling the sticker shock in the gas prices
yeah,
that gets them to work, and they're feeling it in their food prices. I just was
yeah,
just over at the grocery store the other day. I was shocked just for a couple items. You're at $50 right nowadays, right,
yeah,
for
yeah,
just a handful of 3 or 4 items, and so
yeah,
there's real sticker shock out there. Moreover, I think some of the instability that potentially could be pouring out from the inflationary pressure in the emerging markets,
yeah,
where in America we spend about 5% of our wage on food, but if you're sitting in Egypt or if you're sitting in a
yeah,
rural country, you might be spending half of your wages, and if that doubles, you're out of money, and a lot of
yeah,
revolutions and bad things start happening. So.
yeah, yeah. Yeah, I mean, I think what I take out of this is if we think about the portfolios that we're running and we're the homegrown strategy, is that the idea is that you've got this sort of balloon Bear in mind, you mentioned how EM, China, Asia Pacific in general, in our measures, they're some of the most attractive valued markets. On the other end, the US is by far the most expensive market when we adjust multiples over time and how it trades, followed by the European markets. What's interesting is European multiples have adjusted very quickly down, where it really was a neck and neck situation, US, Europe. We've seen Europe sort of gap down a bit. My point is that markets rarely go back to averages, right? We tend to overshoot. And so we've got this moment where the innovation stocks are breaking. Unless we can claim rate risk is behind us, we think that sort of trade that's occurring, it's not over. So we do have, there's quite a chance now that it begins to spread to some of the quote unquote safe bellwether tech. And I believe that's what we've begun to witness in the recent few months. We're tying it back to the earnings story, but I think there's a much more secular moment here.
Well, I think you're absolutely right, Satya. People have been hiding, and they've been very well rewarded in the last few decades, especially in retail, to buy on the dips, the big mega caps, and the mega caps keep on growing, and whether they be in the tech complex. Or in the large cap growth companies. But we're in a situation where they're doing the same, hiding out in the mega caps, and we're starting to see the cracks. Google just reported earnings yesterday, and the numbers were soft, as you would expect. They are the advertising market. There's not much more market share to take from the traditionals today, and so they're going to move with a cycle. So I think the struggle that we are seeing is money, flowing either to the growth stocks, which typically do well as a recession starts kicking in, and or going back to the value stocks because the market can't decide whether or not we're going to have a recession or not, and because they have better valuation support. But I think we've got almost a perfect storm brewing, and I've never been so I guess short in a long time, just because we just see a very tough situation with rates rising, with a lot of inflationary pressure, which I think you talked about earlier, on the supply chain side, which is here to stay. It's not just a COVID fly-by-night and our little masks and we've been done with it. It's more than that. It's a total rearrangement that's going to take a long time. Not talking about 3 months, we're talking about years to reorient. There's not one CEO probably who's not being asked a question on what's your alternative source strategy to China or to other countries.
There's a lot here. Let me unpack a couple quick things. One, you got into the net posture, and I think that's a super important thought as well, which is there's some research we did years ago that basically walked through this logic of saying, if you're to look at periods where the hedge strategies really worked, it was a period in which the short book kicked ass, right? And if you draw a linkage between the relative performance of hedged indices versus long market, right? What you'll find is there's some pretty wicked cycles in there. Importantly, a corollary we found is that if we were to overlay growth to value, guess what? The short book shined in value-driven runs. And I think this is super important. And your point about you're looking at the fundamentals of specific moments, and you're by design or chance, your net posture is shorter. And our message is what we've seen empirically with the way the short mechanism works is that if valuations matter, if your tools are working, then the short book is going to really offer protection. In other words, active 101. So this is an interesting moment. You don't want it because, who wants to see capital markets get swung around like this? At the same time, if you're active and you weren't getting rewarded because there was this outside force inflating everything, all of a sudden, gosh, maybe it's a different chapter.
Absolutely.
Yeah. Let's get into the resource markets for a second. What we've observed is, magically, Canada, Latin America, other markets, including parts of Asia, like let's say Australia, South Africa, right? Very select places are all of a sudden getting inflated. And the question is, if we're in a world of commodities higher for longer, and that's, we don't need to call that, but if you're going into this different sort of world, at least for a while, does that linkage transfer over to the EM markets, right? Do we end up seeing sort of like a, developed market struggle as we're bidding resource markets?
Yeah, it's a great question, Satya. I've always taken a pretty simplistic view, and some of viewers would probably just may of course be able to poke some holes into it. But big picture, China has been the vacuum cleaner for global resources over the last 2 decades, period. And so when China does well, resources are consumed in large quantity. And when China doesn't do well, you see some faltering. And that ties into a lot of the other EMs, which are more commodity based, be it Brazilian copper or iron ore, be it Australian iron ore, be it Canadian timber, or be it Russian oil and gas. That's big picture. You can always find, an outlier in potash or in a specific commodity that is well needed in other parts of the world too. As you know, we have a fertilizer crisis as well, because a lot of the fertilizer around the world comes from Russia, and that not only impacts the U.S., it impacts places like China, as well as Southeast Asia as well. So I think the net of it is that the emerging markets complex and the commodity-driven economies are quite dependent on China. I think there's a two-speed thing that's going on, which is very interesting right now. That there are the Russian neutral and pro-Russian camps, which actually are net buyers, whether it's India or Africa or Middle Eastern countries, of Russian oil. China, because it's in the spotlight, is being prohibited from purchasing anything in addition to what their commitments have been in support of America and the Ukrainian defense and war effort. So there's two markets. One market, which is the replacement market for what we just lost in Russia and Ukrainian resources. That's, I think, affecting positively the supply chain for that Canada and Australia and some of the Middle Eastern countries are supplying. And then there's a discounted market that's quote unquote under the less desirable oil because it's tainted morally, that's going to other countries
Right.
which are willing to absorb it. So, but the overriding issue, I think, is China, I've been a China bull for decades, as you know. I did my thesis on modernization in China. It's been the modern miracle, lifted more people out of poverty than any nation in history. I'm a pretty solid bear on China unless we get regime change. And I think that is the first time I'm coming on record saying that. I think we have a very powerful leader in China who's punch drunk on China on power, and it's a little bit less than flexible regime. And the checks and balances, that delicate balance of that China found post 1980s, when they were very, very difficultly restructuring their economy from a command-driven economy to a market-driven one, where regulators became regulators and not operators, and businesses got to operate as businesses, and they didn't have to operate a hospital, they didn't have to operate a dormitory or provide residences to staff. That's all going in reverse right now in China with this new leader who somehow is quite convinced that the old way was better. I think there's some pressure that has been happening because of the wealth poverty gap that we are seeing not only in the US or in Europe, but also in China. The methodology of approaching it is more draconian in China. Well, they'll just say, okay, well, that business is no good because there's a rich guy, I think named Jack Ma, who's got too much money. Let's just kill it. And so $500 billion gone. Instead of saying, okay, well, you guys who are billionaires, we're going to try to tax you more. Well, that seems to be a good thing to do. Well, you don't want to give it to us, go give it to charity and help poor people. China is basically instructing a lot of the large entrepreneurs and billionaires to go out there and solve rural poverty. So suddenly you got Alibaba and Tencent, who are tech companies and fantastic tech entrepreneurs, building pig farms and trying to bring vegetables to the poor. So it's a very strange dystopia that I think China is going through. I think the world's just catching on to what's happening in a glimpse, because we're kind of distracted by Russia and Ukraine. But the largest juggernaut of commodity use, and even to this day, where China, if you look at the chart, still consumes the vast majority of cement, lumber, fertilizer, food. It's a larger importer of oil from Saudi Arabia than the United States today, is kind of threatened by a leader who's kind of pushing the economy more towards a command-driven place. And there's a lot of chaos going on with the COVID zero, as you know. So we'll have to see how things, adjust. There's he's rested his entire, reason for demonstrating superiority, which is his obsession of his system on this COVID zero, and he's not letting it go, but it's choking off the economy. I think the numbers that are going to come out of China, they're quite desperate. Last night but the numbers are going to be vastly negative. The goal this year was about a 4.5% to 5% GDP number. First quarter was 4.5%, and we are negative, very solidly negative double digit right now. Which on the macro side, which has yet to eke into the marketplace. So if China posts a +1 or 2 number, that would be very good already. They are stepping on the gas for infrastructure spending very heavily, which is an old standby. My analyst in Beijing actually cynically said, well, what's the point of infrastructure? All the roads are empty. All the beautiful rails are never used because everybody's 400 million people are under lockdown right now. So this could be temporary. I think they say that September and October, when she gets sworn in as for another 5 years, that the COVID zero policies may dissipate. But irregardless, we've seen enough, I think, in the last couple of years to be quite convinced that you should be net short China. The valuations look good. They're very attractive, but the foundation from which the companies operate has changed very radically.
Yeah. It's funny you should say that. We issued a report last fall to argue how discounted the China shares have become. The one thing we couldn't square was how globally credit spreads in developed markets were at historical lows. And the closest thing we could get to a proxy for that region was the emerging market high yield measure. A lot of it ended up being real estate China centric. But the bottom line is those spreads have blown out to near pandemic highs. So the bond market's telling us there's something really wrong here. And a discounted market doesn't only signify opportunity, it could signify dead money, right? I mean, you're in a really interesting window, and policy-wise, when the winds are shifting this much as an investor, be careful chasing value, right? Sometimes you get what you pay for.
Yeah, no, that's a great point, Satya. I mean, we've, gone through a cycle through a downturn in real estate in a lot of emerging markets over the years since I started investing in EM in the 90s, and seen spreads blow out as far as 10% to 18% over the US Treasury equivalents. Chinese real estate spreads are running somewhere between 18 to 25% on their dollar debt. Most of them are in default. Most of them will be in default. The odd part about it is, again, this dystopia that's being created in China is self-inflicted. So these companies did not need to go bankrupt. There has been a need to rein in credit, and I think the government has tried to do so, but they don't have a very clear bankruptcy law in place. So, the way that these companies are working through it is telling their creditors overseas, don't sue us, just give us some time and we'll kind of figure it out. Meanwhile, they're paying out some interest domestically, missing some coupons overseas, and once in a while throwing a payment in, but they are technically in default. And because I think what the government is very pro state-run companies. This is why I mentioned that there's a dystopia going on. The focus on the private sector as being the engine of growth has been lost over the last 3 to 5 years. So the intent, as horrible as it sounds, is for the government to bankrupt the private sector by restricting credit for them, so the public sector, state-run companies can come in and sweep up cheap assets. But problem by playing around with the market in such a way, which I think a more centrally controlled system has been used to being able to maneuver, is that the effect may create a lot of unintended consequences, like a wholesale collapse in the system, right? And so they've been able to successfully avert multi-billion-dollar collapses by quietly dispersing assets of Anbang and of H&A. That was one of whom owned the Waldorf Astoria in New York, and it just kind of disappears into some state-run group of companies. And so this real estate debacle, though, is quite large, and I think the government's intent is to try to make sure that depositors get paid and were delivered with their home, and that the developers take the hit for it. So, but the problem is that the invisible hand of Adam Smith is kind of disappearing. And so the lessons of the last 30, 40 years that kind of powered China, which is a very pro-business friendly environment, one that is flexible yet directed, is kind of going to more directed and unflexible. And so, and they're using alternative methods to try to force a economy that has been more freewheeling to bend to their wishes. So they want to grow the pronouncement yesterday was by the Supreme Leader to have growth that's faster than the United States. Now, why they want that, I don't know. It's one of these weird competitive things, but the way they can do it is through infrastructure spending. So they're going to have to borrow a couple $1 trillion, to do that. The U.S. dollars, right? So
and
I would say it's more the latter, which is that there's more there's smoke right now, and the fire is about ready to blaze. I mean, you really got just to wrap up a credit crisis. That's impending on the real estate side, which is somewhat buttressed by the marketplace. You've got a government that's unfriendly to large tech companies, and more large tech fortunes have been created in China than the U.S. over the last 2 decades. That's gone, and you've got a infrastructure that's pretty well built, but they want more. And you've got half the population, a third of the population under rolling lockdown. So it's very messy right now.
I think we're bracing for that on the domestic front. If you look at the global portfolios, one of the realities we've sort of had to address was this idea that no longer is the EM index a reasonable composite that we should be watching as closely. If you bifurcate that a bit, there's some markets that are actually doing quite well.
Latin America is doing very well. We've got some holdings in Latin America that are doing fabulously well. Brazil, I think, is a natural replacement supplier for Russian oil and gas, and also commodities at the end of the day. And Latin markets, are tied to the U.S. Sphere, if you will. And it should be quite well insulated, and more capital going to that space. So I think that's where the interesting opportunity is the non-China related EM and commodities trades.
And in fact, we no longer have to strip Russia out of the EM index. It's been done for us. I think it's kind of funny that we're all quoting how the Russian ruble has come back, and people are sort of saying, well, everything's fine. I'm like, wait a second. The capital markets is still shut down, guys. Like nothing's happening. I saw an interesting clip from the Bill Maher show recently. He said, with these companies being kicked out, they're getting very creative in Russia. And so at one point, so McDonald's is gone, but did you know there's McDonald's there? And they have the new logo, and it's literally a McDonald's sign like this. So it looks like a B. It's according to that piece, it's real. But then he went on to other real products that weren't real. But it's a weird moment. And I think as investors here and trying to run a business professionally and a portfolio professionally, it's like you're throwing a curveball where, like we weren't trained with these elements in our business school days, like, oh, how do we completely rejuggle the way we're framing the world? How do we decompose the index now? Because some of that's not real. That's complicated stuff. I do think, though, that when we look at what you said about infrastructure, ironically, the U.S. has sort of like gotten onto this mantra, and the irony is infrastructure meets climate is something that if all of a sudden energy becomes national security, potentially you end up seeing some serious infrastructure spending. And so we've done some work, theme work on infrastructure, where we think that for a number of reasons, the pandemic, ignored infrastructure, et cetera. But then you throw this whole new reality about energy as security again, kind of like the 70s, the turbines, solar. Most of that development in the 70s came about not because of climate. It was because energy was a national security issue, right? So if we begin to label this again, you probably end up seeing more spending down these channels. And I do think we call them the IMEs, industrial material energies. We were doing this in 2001, 2002. The difference was it was China almost solely. If you flip it around at 22 to 25, it's probably Europe, US that will drive some of the spending. Clearly, China's going to be there, but you may have yourself an even more powerful cycle of this sort of gritty equity market.
Yeah, no, that's absolutely right. I think the world of equities may even also be bifurcating. We've seen, of course, the Russian market disappear in front of our face and go to zero. And I'm sure the Russians are going to find their own way to try to regen it. China is bifurcating as well. We're trying to kick off, I think in the US, a lot of the Chinese companies by 2023, and a lot of Chinese companies have delisted and moved to Hong Kong. And again, the energy markets in IME get bifurcated, as I mentioned a little bit earlier, between countries that are US and friends and others that are China and friends. So maybe China imports from, in Iran, and a little bit from Russia, and Europe and the US are importing from the Middle East, and everybody imports from Saudi Arabia at the end of the day. So there's going to be some countries who are going to play, well, many of the countries actually, not the majors, are going to be trying to play both angles and be friends to everybody. I think the China-US relationship is so complicated, and it's actually more positive than in Russia, where less than 3% of our GDP is tied to Russia. Most of the case, less than 1%. So it's easy to cut it off. China is a different story, where supply chains and customers and vendors are all tied together and integrated with the rest of the world. So pulling ourselves away from that relationship will hurt both countries at the end of the day. So you hope common sense kind of in terms of where we look to approach investing in the IME complex. We always have said that go for commodities that are short in supply and that the world needs. So I think you see interesting corrections in the EV supply chain for lithium companies, of which China produces 70% of the world's lithium right now, right? So there's opportunities actually even within in the Chinese market there. Outside of China, I still think that you're seeing good opportunities in alternative energy. They may be solar or wind power companies. They also may be actually nuclear. Nuclear is one of the cleanest energy sources. It's just a question of whether or not people can get over the hump of feeling comfortable that it won't cause a severe accident that'll kill
Yeah.
everyone.
Yeah.
So,
Yeah. Well, wow. Last question for you. In terms of just in terms of framing the portfolio, I mean, we got some hints about what you're doing without sharing any specifics. You know, what is different in your in how you're attacking the markets today versus just 6 months ago? What's changed in your mind? Like, is there a meaningful drift or reversal that's impacted you?
yeah, absolutely. I think in the last several decades, you could count on a cadre of companies and managements who were innovative, and who could take share in new industries and or adapt technologies to what they were doing to grow. You would always have your stalwart banks and operating companies who also were dominant in their space. We're still looking for high quality companies in that way, but I think a lot has changed in terms of the regulatory environment in the technology space, for instance, making technology, especially in places like China, much more complicated and difficult to invest in. The US, I think, in Europe are a little bit farther behind. Europe is actually quite aggressive in terms of penalizing the Googles and the large information providers, which I think we all know is well overdue. What I think thematically, what's really changed for us is that inflation, we believe, is here to stay. We don't think this is a passing thing for a moment. We think we're back to the 1970s. I think you just have to understand the geopolitics of the world, and that we're splitting back up into two worlds right now, and then
Yeah.
just figure that the markets are going to look a lot like the 1970s, where we get real cycles, and when there's
Yeah.
a shortage of a strong demand cycle like we have right now, there's a shortage of what? Labor, food, everything. So inflation
Yeah.
goes up, and the Fed's got to raise rates, and
Yeah.
we've got to adjust our portfolio as such. So I think we're quite late cycle in this stage, but I think because inflation's here to stay, we're very interested in companies that have pricing, that are price makers rather than price takers. We think a lot of the consumer staples companies have that ability more so than even large tech companies. Of course, there are companies across a multitude of different industries that can make price, but most of the time, a lot of companies, are going to be feeling squeezed, I think, with higher labor costs, and at the same time, a slowing demand equation, and that's
Yeah.
never a good situation. So
Yeah.
we're expecting actually some difficult times on the equity markets. Then you add the
Yeah.
yield component to it, which we talked about the earlier part of the conversation, with rates needing to come up to catch up with inflation, and suddenly you have a discounted cash flow number that is going to look very different to the equity markets vis-a-vis versus
Yeah. Yeah.
excess liquidity environment we've been in. And
Yeah.
so it just takes time to work its way through the system. So I think we're in for some rough sledding over here. So
Yeah. No, I hear you. I think this has been a bit shocking for a lot of us. I think coming through the I'm hoping we came through it. We're coming through the pandemic, but I do think that the monkey wrench in this is how dramatic the pandemic has been into the pricing equation. And chance has played a role, that you've got this structural thing that came onto this moment. So you've got something that was probably going to be a 2-year event. Now you've got geopolitical moments that have really created a secular inflationary call.
yeah.
And what do you have right now is both, right? And so I think the numbers are going to probably overshoot, but you're right. This is not a 2% 10-year world for a
No,
while.
no.
Yeah. Yeah. So yeah, again, thank you.
Absolutely.
Historically, I've always enjoyed our conversations. I always feel like it's odd that we were supporting or working with you when, for instance, when I read your newsletter, I'm like, oh my gosh, I'm like, Ken, how long did it take you to write this? And so I don't know if you've still got those links available, but I think, if they're public, I think
Yeah, we'll make sure that you have
yeah,
you're on it. So
yeah,
absolutely, and always
I,
great
I
to see you
certainly,
too.
yeah. No, that's terrific. And thank you very much. And yeah, look forward to you just working together.
Super. Thanks, Satya. Good
All
luck
right,
to you,
sir.
and great to see your work as always and your insights.
All right.
Always a pleasure for you for us to kind of get the holistic view of the entire world based on very solid quantitative work that you do. So
Thank you. Thank
great
you.
work.
All right.
All right,
Thanks,
take care
sir.
now.
All right. Cheers.